New York, October 1987. A portfolio manager sits at his desk at 7:30 in the morning. He manages retirement accounts for 200 families, school teachers, nurses, small business owners, people who trusted him with their life savings. He is looking at 3 different positions in his portfolio, all carefully selected, all considered safe. First position, large cap US stocks, diversified across 30 companies, blue chip names, stable earnings, defensive sectors. Second position, investment grade corporate bonds, I-rated, issued by companies with decades of history, bonds that were supposed to move inversely to stocks. Third position, international equities, European firms, geographic diversification, a hedge against domestic volatility. On paper, this portfolio was textbook risk management. 3 different asset classes, different geographies, different risk profiles, the kind of diversification every investment course teaches. By the close of trading that day, October 19th, 1987, all 3 positions had collapsed simultaneously. Stocks fell 22.6% in a single session, the largest one-day percentage decline in market history. Corporate bonds fell as issuers faced sudden credit stress and liquidation pressure. International markets fell harder than the US market as panic spread globally. The portfolio that was built to survive volatility through diversification lost 38% of its value in one day, not because the assets were wrong, because they were all the same type of asset in a different costume. The manager made 200 phone calls that week to people who had trusted him, people who had believed that diversification meant safety, people who discovered that their diversification was an illusion. What most people do not realize about financial diversification is that it works perfectly until the moment you need it most. Then it reveals itself to be something else entirely. Not protection, concentration risk dressed in multiple wrappers. The forensic record of every major financial crisis in the past century shows the same pattern. Paper assets that are supposed to protect against each other fail together, not occasionally, systematically, and not because of bad luck, because they are built on the same foundation. The autopsy of this pattern reveals something uncomfortable: the distinction between stocks and bonds, and real estate funds and international funds is a distinction of form, not substance. When the underlying structure fails, form provides no protection. The first thing the forensic record shows is correlation breakdown during stress. In normal market conditions, correlations between asset classes behave as theory predicts. When stocks decline, bonds often rise as investors seek safety. When domestic markets struggle, international exposure provides balance. When equities suffer, real assets like commodities move independently. This relationship is not theoretical. It is observable and measurable across decades of market data. From 1950 through 2007, the correlation between stocks and bonds averaged near zero, sometimes positive, sometimes negative, generally uncorrelated. Exactly what diversification theory requires. Then comes the stress event, and the correlations converge toward 1. October 2008, the height of the financial crisis. Lehman Brothers has just collapsed. Credit markets have frozen. The S&P 500 falls 48% from its peak to its trough. Investment-grade bonds, which should provide ballast, fall 17%. High-yield bonds fall 33%. Real estate investment trusts fall 63%. Commodities fall 53%. International equities fall 49%. The portfolio that was diversified across 6 different asset classes lost 42% of its value, nearly identical to holding only stocks. The diversification provided almost no protection. The pattern repeats. March 2020, the COVID crisis begins. Markets collapse globally within weeks. Stocks fall 34%. Investment-grade bonds fall 13%. High-yield bonds fall 22%. Real estate falls 41%. Commodities fall 37%. Again, the diversified portfolio loses nearly as much as the single asset portfolio. The protection disappears precisely when needed. The principle is clear. Correlation is not stable. It is conditional. During systemic stress, when risk appetite collapses and liquidity evaporates, correlations converge. Assets that are supposed to protect against each other fail together. The reason is structural. These assets are not truly different. They are claims on the same underlying system, claims priced in the same currency, traded through the same intermediaries, held by the same institutional investors who must liquidate positions to meet redemptions or margin calls. When the system itself comes under stress, the distinction between asset classes collapses. Because the distinction was never about fundamental differences. It was about behavioral differences that exist only during stability. The second pattern the forensic record documents is liquidity illusion. Paper assets are considered liquid. Stocks can be sold in seconds. Bonds trade actively. Real estate investment trusts are exchange traded. Liquidity is not just a feature. It is the primary selling point. You can access your wealth instantly. No delay, no friction. This liquidity is real during normal conditions, but it is not a property of the asset. It is a property of the market. And markets are not mechanical systems. They are human systems built on continuous bidding. When everyone wants to sell simultaneously, there are no bids. The liquidity disappears. September 2008. Reserve Primary Fund, a money market fund considered as safe as cash, breaks the buck. Its net asset value falls below $1 per share because it held Lehman Brothers commercial paper. Within 48 hours, investors attempt to redeem $300 billion from money market funds industry-wide. The funds cannot meet redemptions, not because the assets are worthless, because there are no buyers. The market for commercial paper has frozen. Assets that were liquid yesterday cannot be sold today at any price. The funds halt redemptions. Investors with money in instruments designed to be more liquid than checking accounts cannot access their funds. The liquidity was not a feature of the asset. It was a feature of market confidence. When confidence broke, liquidity vanished. The same dynamic appears in every crisis. October 1987, stock exchanges implement circuit breakers because selling pressure overwhelms the system. Liquidity disappears for hours. March 2020, corporate bond trading halts repeatedly. Spreads widen to levels that make selling prohibitively expensive. The liquidity exists until you need it. Then it vanishes. The principle is that paper asset liquidity is borrowed from market stability. During stability, markets function smoothly because there is a balance of buyers and sellers. During instability, everyone becomes a seller simultaneously, and selling requires a buyer. When there are no buyers, the asset is not liquid regardless of its normal characteristics. The distinction matters because liquid assets are supposed to provide flexibility during crisis, the ability to reposition, to preserve capital, to avoid permanent loss. But if the liquidity disappears during the crisis, the asset provides no flexibility at all. You are locked into a falling position with no exit. The third mechanism the record reveals is embedded leverage. Most investors believe they own assets directly. They buy a stock fund. They own stocks. They buy a bond fund. They own bonds. The relationship seems straightforward, but paper assets exist within a chain of intermediation. Each link in the chain operates with embedded leverage. The investor may not use leverage, but the system through which they hold assets does. February 2008, Bear. Stearns operates with 33-to-1 leverage. For every dollar of capital, they control $33 of assets. These assets include mortgage-backed securities, held by funds that individual investors own. When the value of those mortgage securities declines even slightly, the leverage amplifies the loss. A 3% decline in asset value against 33-to-1 leverage wipes out the entire equity. The fund fails. The investors lose everything, not because the underlying mortgages became worthless, because the leverage embedded in the structure magnified a manageable loss into a catastrophic one. This leverage is invisible to the end investor. They see a fund with a stable net asset value. They do not see the balance sheet of the intermediary holding the actual securities. They do not see the repo agreements financing the positions. They do not see the margin requirements that force liquidation during volatility. But the leverage is there, and it creates fragility that the investor never agreed to accept. September 2008, Lehman Brothers fails with leverage ratios exceeding 30-to-1. AIG requires a government bailout because it wrote credit default swaps without adequate collateral, an embedded leverage position invisible to the pension funds and insurance companies on the other side of those contracts. The principle is that paper assets embed systemic leverage that individual holder decisions cannot control. You may invest conservatively, but if the intermediary through which you hold that investment operates with extreme leverage, your conservative position is actually highly leveraged. You have outsourced your risk management to an entity whose incentives do not align with yours. When stress arrives, that embedded leverage forces liquidation regardless of your intent. Margin calls are not negotiable. Redemptions must be met. Collateral must be posted. The selling pressure originates not from investor decision, but from system mechanics. The fourth factor the forensic record shows is common dependency on monetary policy. Paper assets are priced in currency. The value of that currency is managed by a central bank. The central bank's policy determines the discount rate applied to all future cash flows. All paper assets, regardless of type, are sensitive to this discount rate. When monetary policy tightens, the discount rate rises. The present value of all future cash flows falls. This affects stocks and bonds and real estate simultaneously, because they are all claims on future income denominated in the same currency subject to the same monetary policy. This creates a hidden correlation. In normal times, stocks and bonds move differently because they are sensitive to different factors: growth expectations, credit quality, inflation. But they are both sensitive to the underlying interest rate structure, and when that structure shifts dramatically, both move together. 2022 provides a recent example. The Federal Reserve begins the most aggressive tightening cycle in 40 years. Interest rates rise from 0 to 5% within 18 months. Stocks fall 25%. Bonds, which are supposed to provide stability, fall 13%. This is not a small decline for bonds. The Bloomberg Aggregate Bond Index, the benchmark for investment-grade bonds, posts its worst year in its history. Bonds that were supposed to protect portfolio value during equity declines instead amplify losses. The reason is structural. Both assets are priced using the same risk-free rate. When that rate moves violently, both assets reprice simultaneously. The diversification between them is an illusion. They are both leveraged bets on the same underlying variable. The principle is that all paper assets share a common dependency on monetary policy because they are all claims denominated in the same managed currency. This creates a single point of failure. When monetary policy breaks, or tightens unexpectedly, or loses credibility, all paper assets suffer together. You cannot diversify away from this risk by adding more paper assets, because they all embed the same dependency. The fifth dynamic the record documents is institutional herd behavior. Paper assets are predominantly held by institutions: pension funds, mutual funds, hedge funds, insurance companies. These institutions collectively control trillions in assets, and they operate with similar mandates, similar risk models, and similar incentives. When market conditions deteriorate, these institutions respond similarly. Not because they are irrational, because they face similar constraints: redemption pressures, margin requirements, risk limit breaches, regulatory capital requirements. This creates coordinated selling pressure, not coordinated by conspiracy, coordinated by structure. When one institution must sell to meet redemptions, that selling pressure affects prices. Falling prices trigger risk limits at other institutions. Those institutions must also sell. The selling creates a cascade. October 2008. After Lehman fails, redemptions surge across hedge funds. Hedge funds must sell liquid positions to meet redemptions. The most liquid positions are high-quality stocks and government bonds. Selling pressure intensifies. Prices fall further. More institutions breach risk limits. More selling follows. The cascade is mechanical. Each institution is acting rationally given its constraints. But the collective behavior creates a liquidation spiral that none of them individually intended. The principle is that institutional ownership of paper assets creates correlated selling pressure during stress. Individual investors believe they control their selling decisions, but they hold assets through institutions whose selling decisions are mechanically determined by mandate and constraint. When those constraints bind simultaneously across many institutions, the selling pressure is not a sum of individual rational decisions. It is a systemic force that individuals cannot escape by holding different paper assets, because all paper assets are held by institutions facing similar constraints. In January 2026, the United States debt to GDP ratio stands at 124%. Interest expense on that debt exceeds $1 trillion annually. The Federal Reserve's balance sheet, which was $800 billion before the 2008 crisis, now stands at $7 trillion, a nine-fold increase. Central banks globally have expanded money supply by unprecedented amounts. M2 money supply in the United States increased 25% in 2020 alone, the largest single-year expansion in recorded history. Simultaneously, central banks have purchased 1,000 tons of gold annually for 3 consecutive years, double the prior decade's average. These are not consumer purchases. These are institutional purchases by entities with privileged information. About system stability, the question is not whether the current system will experience a crisis identical to 1987 or 2008 or 2020. The structure has changed. The scale has changed. The policy tools have changed. The question is whether the underlying dynamics that cause paper assets to fail together are still present, and whether those dynamics are intensifying. The forensic record suggests they are. Debt levels are higher, leverage is more widespread, asset prices are more sensitive to monetary policy because interest rates were held at zero for longer. Institutional ownership is more concentrated, and the correlations between supposedly different asset classes are already elevated relative to historical norms. History suggests that when these conditions are present, the next stress event will again reveal that diversification across paper assets is an illusion. Not because investors are foolish, because the distinction between paper asset types is a distinction of label, not substance. During stability, the labels matter. Stocks behave differently than bonds. Domestic assets behave differently than international assets. The diversification appears real. During instability, the labels disappear. All paper assets become the same thing. Claims on a system under stress, denominated in a currency being managed in crisis mode, held through intermediaries forced to sell, priced by institutions with identical constraints. The manager who made 200 phone calls in October 1987 did not make a mistake in portfolio construction. He followed best practice. He diversified across asset classes. He balanced risk. He did everything correctly according to accepted theory, and his clients still lost 38% in one day. Not because he failed, because the theory fails during the only time that matters. The uncomfortable truth the forensic record reveals is not that diversification is bad advice. It is that diversification across paper assets is not actually diversification. It is multiplication. More positions in the same underlying structure. When that structure is stable, multiplication creates the appearance of safety. More positions means more independent sources of return, more ways to avoid concentration risk. When that structure is unstable, multiplication creates the appearance of safety while providing none. More positions means more exposure to the same underlying failure mode, more ways for the same risk to appear in different forms. The distinction between real diversification and false diversification is not about the number of positions. It is about the number of systems those positions depend on. Paper assets depend on monetary stability, on financial intermediary solvency, on continuous market liquidity, on institutional risk appetite, on policy credibility. When any of these dependencies breaks, all paper assets suffer, because they all embed the same dependencies. The form is different. The risk is identical. This is not a prediction that paper assets will fail. It is an observation that when they do fail, they fail together, and that this pattern is not historical accident. It is structural inevitability. The question is not whether to avoid paper assets entirely. For most people, that is not practical. The question is whether to recognize that holding multiple types of paper assets is not the same as holding multiple types of assets. Paper is not the same as land, or commodities, or productive businesses you control directly, or skills, or relationships. These assets exist outside the paper system. They do not depend on financial intermediaries remaining solvent. They do not depend on markets remaining liquid. They do not depend on monetary policy remaining credible. When paper assets fail together, these assets continue to function because they are not claims on the system. They are the things the system is built to manage. The forensic record is clear. Paper asset diversification provides protection during stability. But stability is not when you need protection. You need protection during instability. And during instability, paper asset diversification fails. Not sometimes, systematically. This is not a flaw in specific portfolios. It is a feature of paper asset structure, and it repeats because the structure has not changed. Only the scale has grown. If you value forensic analysis of financial system, structure rather than surface level investment advice, subscribe to the Wealth Forum. The pattern is documented. The mechanism is understood. The question is whether you will recognize it before the next demonstration. The portfolio manager learned the lesson in 1987. Diversification across paper assets is not diversification across risk. It is concentration risk in multiple wrappers. The wrappers are different. The risk is the same. And when the risk materializes, the wrappers provide no protection. That is what the autopsy shows.